Folks, it's 5 o'clock, so I'm going to start because we have allotted about an hour for this. I'm, of course, a little flexible. Doesn't mean at 6 sharp I'm going to stop, but we'll take it to the logical end. Whether it takes an hour, it takes an hour and 10 minutes. And if possible, we'll have a little question-answer session. So let me start. Topic selected for today after a lot of thinking, because as you know, I had asked you for suggestions. And then I realized asking suggestions really doesn't help because there are as many suggestions as the number of people. So I said we'll probably do more such sessions as time permits. Nowadays, even professionally, since everybody is at home, we have started doing some webinars for corporates and so on. So time permitting, I will do more of these Facebook live sessions. So today we've decided to take Darshan Chawla, welcome. Today we've decided to take a topic from a business point of view, but I think even individuals should be familiar, because balance sheet reading is something that it can be of use to you in numerous occasions. Whether you're running a business or you're working for an organization or you're trying to choose stocks to invest in, on numerous occasions, if you know how to read a balance sheet, it will be of use to you. So folks, pardon me, like I said, I'm going to use this from time to time. When I don't need, I'm going to shut it down again. So topic is how to read a balance sheet. But before that, I need to introduce a balance sheet to you. For the benefit of those who may not be aware, some of you will be more familiar than others. So my request would be, those of you who are more familiar, bear with me till I'm going to address for the first few minutes those who know nothing about a balance sheet. What of course most people will know, that the two sides of a balance sheet, one side shows liabilities, the other side shows assets. Now frankly speaking, liabilities represent sources. Liabilities tell you where the organization has got its money from. So liabilities can be called sources, and assets represent what you did with the money. You spend the money and buy the assets. So assets represent uses. Where does a business get money from? Let's say you start a business. Let's say one of you, let me pick up any name. I can see Manish Kumar in front over here right now. Let's say Manish Kumar starts a business. And Manish wants to start, let's take an easy business. He wants to start manufacturing furniture. Now, where will this company, he starts a company called Manish Furnitures. Now Manish Furnitures needs money. Where will it get money from? When a business needs money, folks, it has only one option, and that option is to borrow. Who does a business borrow from? It borrows from the owner, and it borrows from an outsider. So we treat, of course, the owner as different from the outsider. For accounting purposes, Manish will be considered as separate from Manish Furnitures, even if it's a proprietary concern. If he starts a company or something, then genuinely they are two different entities. But even if it's a proprietary concern, for the sake of the balance sheet, we will consider Manish to be a separate entity and Manish Furnitures to be something else. Manish Furnitures, I'm going to call it as MF now onwards. MF needs money. So the first person MF will go to will be Manish. Manish, give me money. Let's say this company needs, I can use small numbers, I can use large numbers. Large numbers make the impact a little more. So let's say the company needs 1,000 crores. And let's say Manish, he could be alone, there could be many of them. If there are many of them, they will be called shareholders. If he's alone, he'll be called proprietor. Let's say the proprietors put in 400 crores. The proprietor puts in 400 crores or the shareholders put in 400 crores, that will be called capital. But the requirement was 1,000 crores. So for the remaining 600, they go to a bank or something, and let's say they borrow 600 crores. Folks, since both are in the nature of borrowings, one is a borrowing from the owner, the other is a borrowing from outsider. But since both are in the nature of borrowings, both appear on the liability side of a balance sheet. Very often non-finance people get a little confused. Why is capital shown as a liability? Answer is because so far as the business is concerned, it's a loan. But tell me, what is the difference between Mr. Manish as a lender and, let's say, the banker as a lender? What's the difference? The difference lies in the terms of lending. On what terms did Manish lend? On what terms did the banker lend? You will all appreciate, folks, no lender is ever going to lend you money without asking a series of due diligence kind of questions. So when Manish Furnitures wanted money and it went to Mr. Manish and it went to the banker, both of them must have asked several questions. What kind of questions? Questions designed to understand the need for money, the ability to intelligently deploy the money, the ability to generate revenue, the ability to service the loan, the ability to repay the loan. So when these questions were asked, what answer they must have received? Manish Furnitures must have said, folks, I am asking for money because I intend setting up a furniture manufacturing enterprise. So, guys, I'm going to take your money and first of all, I will use it to buy some fantastic assets for myself. Then I will use your money to buy raw materials. I will use your money to hire people. And once my product is ready, I will use your money to do marketing and sales. And then when I have sold my product, I'm going to reward both of you. And both these people must have said, and what if you don't earn? Then what happens to us? And if Manish Furniture says, folks, if I make profit, I will reward you. If I don't make profit, how can I reward you? Listening to this kind of an answer, out of these two lenders, one will chicken out, one will back out. Who will back out? Obviously the banker. The banker is going to say, Manish Furnitures, if my returns are going to depend upon whether you earn or you don't earn, then I'm sorry, I'm not interested in lending. I will lend you on one condition. What is the condition? Guarantee me a return. And Manish Furniture must have said, banker, that's pretty unfair. If I don't earn, how can I guarantee you a reward? But we all know there are times in life where beggars can't be choosers. You want the banker's money, you will have to agree to the banker's conditions also. So reluctantly, Manish Furnitures must have said, all right, Mr. Banker, you expect me to guarantee you a reward. That means you expect me to continue paying you a return even if I'm losing money. I'm going to agree to that because I have no choice. But then Manish Furniture must have said, Mr. Banker, then even I have a couple of requests. Request number one, you expect me to carry on giving you a reward even when I'm losing? Then first of all, Mr. Banker, don't keep your expectations very high. I mean, if you want a reasonable kind of a return, perhaps I'll be able to afford it even when I'm losing. Let's say the banker must have said, I'm happy with 10%. Try and keep track with what's happening in front of you on the presentation also. So the 10% I just highlighted, right? So the 10% represents the rate of interest that Manish Furniture is expected to pay to the bank. And then Manish Furniture must have said, Mr. Banker, I have one more request. You want me to pay you 10% even when I'm losing money? I'm going to agree to that. But then on the other hand, don't forget, I might make profit. And I may make a huge amount of profit. Then you, Mr. Banker, don't keep an eye on that. If I'm going to pay you 10% when I'm losing, then I will pay you the same 10% when I make pots of money. Banker must have said, fair enough, I'd rather have the assurance of a guaranteed return than have the possibility of a very high return in 1 year and nothing in another year. Point I'm trying to make. On what condition do outsiders lend the money? Outsiders lend the money on the condition, give us a guaranteed, but a limited amount of it. Now to this conversation between Manish Furnitures and the bank, Mr. Manish is listening to. He now turns around and says, Manish Furnitures, I'm not like the bank. I am not so unreasonable. I understand you will have ups and downs in your life. There are some years you'll make profits, there are other years you may not make profits. Manish says, I am willing to give you my money with no guarantees whatsoever, which means if you don't earn, I'm okay if I get nothing. But then Manish says, you understand, I'm taking a risk, I might get nothing. So Manish says, Manish Furnitures, if you don't earn, you don't have to pay me anything. But on the other hand, when you do earn, and after everybody's been paid off, then I will take everything. Is that also fair? On what terms do outsiders lend the money? Outsider lend the money on the condition, give us a guaranteed but a limited amount of return. Owners lend money on the condition, don't want guarantees, but then don't want limits on how much we can earn either. Folks, this organization takes 400 crores from the owners, 600 crores from the bankers, 1,000 crores get deployed, excellent assets are purchased, the assets are now put into use, and now this organization starts generating revenue. Imagine on deployment of 1,000 crores, this company generates a sales turnover of 3,000 crores. So far, nobody's been paid. I want you guys to visualize and tell me how many groups of claimants can you visualize standing in a line saying we want a share of this 3,000 crores. How will this 3,000 crores be distributed? You have to pay salaries to your employees, you have to pay raw material vendors, you have to pay rent to the landlord, you have to pay the printer, the stationer, the telephone company, the water company, the travel agent. But these are items. I want groups. So can I say all these items that I just mentioned comprise one group called operating expenses? So one group standing in a line will be operating expenses. Second group would be the shareholders who are expecting dividend. Third group would be the lenders who expect interest. And the fourth group would be the government which expects income tax. Folks, when I say government over here, I mean income tax. I don't mean GST, because GST is part of operating expenses. Doesn't matter what line of business you are, doesn't matter where in the world you operate, whatever sales revenue an organization generates will get distributed between these four groups maximum. There are countries like in the Middle East which don't have income tax, so there the revenue gets distributed between three groups. But not in this order. Can you now help me choose the order? Whose claim are they going to entertain first? The first claim would be of operating expenses. First of the month comes, this company's got to pay salaries, they got to pay rents. On the due date, they have to pay, let's say, vendors for raw materials, etc. Let's imagine this organization's operating expenses happen to be 1,600. How much is left now? 1,400. What is this 1,400 called? This 1,400 is called, either it is called the operating profit, or tell me what kind of profit is this? This is that stage of profit where from sales you have recovered the operating expenses, but you still have not paid dividend to the shareholder, you still haven't paid interest to the lender, you still of course haven't paid income tax to the government. So this figure is also called PBIT, profit, but before interest, before tax, and of course before dividend. Or it is called EBIT, earnings before interest and tax. How many groups are left now? 3. Now who will you pay? Sorry, I'm not responding to your messages. I just got carried away with them speaking, but I'm seeing a lot of you responding. Tanya, you're absolutely right. Now you will pay the lenders. How much has this organization borrowed? They have borrowed 600. At what rate of interest? At the rate of 10%. So how much will they pay the government? 60. That leaves you with 1340. What is the 1340 called? From PBIT, you have now paid I, interest. So what is left will be called PBT. Now there are two groups left. You have the shareholders and the government. Whose turn will it be now to be paid? Now you pay the government. Let's imagine the income tax liability works out to 340. You are now left with 1,000 crores. Who does this belong to? This belongs to the owners. Because bankers said we want a guaranteed return but a limited return. Owners said we don't want guarantees. But then after everybody's been paid off, everything belongs to us. So now Mr. Manish and friends, the shareholders of this company would be standing in a line. Please give us this 1,000 crores. But folks, when this company wanted Manish's money, they had gone and made all kinds of rash promises to him that yes, Mr. Manish, all the profit will be given to you and this and that. But now that it's time to actually pay to him, This company starts having a change of heart. They start negotiating with you. They say, Mr. Manish, we said entire profit belongs to you, and of course it does belong to you. You are the owner of the company ultimately. But they say, Mr. Manish, all you have given us is 400. I mean, had you not given this money to us, had you instead put it in a bank, how much would you have earned? 5%? Had you put it in FD, maybe 7-8%, in bonds, etc., 10-12%, in risky ventures, 15, 18, 20, the company says, Manish, take 30 from us. Maybe we can give you 40%. Perhaps we can stretch up to 50%. But don't take the entire 1,000 crores away. Why are they saying this? Are they trying to cheat him? Answer is no. Ultimately, Manish is the owner. Then why? Having promised to him that the entire profit will be given to you, why are they not giving it to him? Why don't organizations distribute the entire amount of profit amongst the shareholders by way of dividend? No company gives the entire profit as dividend. Now, whenever I ask this question in a group of face-to-face when I have an audience, I get numerous answers, and which probably you're also thinking about, that this company needs money for expansion, they need money for growth, they need money for future activity, they need money for exigencies and unforeseen expenditures, and they still haven't returned the bank its loan, etc., etc., etc. And my reaction always is, folks, I will accept all your answers as reason number 2 for not giving it to Manish. But there is a more important reason number 1, which I haven't explained. Fault is mine. Had I started this session maybe with 3-4 hours of input before I reached this level, I would have explained it to you. But I think one of the first things every business person, every entrepreneur realizes after setting up a business is that there is no connection between the profit that a business makes and the bank balance that it possesses. In fact, there is a connection, because if at all there is a connection, I think it's an inverse connection. There's an inverse relationship. Higher the profit, lower the bank balance. If you're not running businesses yourself so far, this statement may or may not make complete sense to you. But anybody who runs a business will bear with me that one of the biggest mysteries that confronts business people is, where is the money? Accountants tell me so much turnover, so much profit, but in the bank there is not enough money to pay my this month's expenses also. Bank balance and profit are two different. It's a different ballgame. And therefore, if this company makes 1,000 crore profit, even if it loves to give it to Manish, folks, to give it to Manish, they not only need a profit of 1,000 crores, they will also require a bank balance of 1,000 crores, which according to me is impossible. A company that makes a profit of 1,000 crores, which has a bank balance of 1,000 crores, I think is impossible. But a company that makes a profit of 1,000 crores, which is accompanied by a bank balance of negative 600 crores, is absolutely possible. So the first and the most practical reason why this profit has not been given to Manish is, where is the money? Assuming on the off chance this company did have 1,000 crore profit and 1,000 crore bank balance, they still would not have given it to Manish. Then the other arguments, the other explanation that you would have given would come in, that this company needs money for expansion, growth, etc., etc. For various reasons put together, Manish Furnitures will convince Mr. Manish, had you put your 400 crores anywhere else, you would have earned 5%, 10%, 20%. We can give you 30, 40, 50, but don't take the entire 1,000 crores away. And who is Manish? He's the owner of this business. He understands, if this is in the interest of the business not to pay it to me, and I happen to be the owner of this business, then it is in my interest not to take it away. Manish says, no problem, Manish Furnitures. You cannot give me 1,000 crores. Doesn't matter. How much can you give me? 50%? Give me 50%. How much money has Manish invested in this company? 400 crores. How much is 50% of 400 crores? 200. 50% of 400, not 1,000. You give him 200 crores. How much is left now? 800 crores. Who does this belong to? Who does this 800 crores belong to? Can I see some answers? Folks, in case you are thinking this belongs to Manish Furnitures, I want to set that impression right. It does not belong to Manish Furnitures. This 800 crores continues to belong to Mr. Manish. When Manish agreed to accept 200 out of a profit of 1000 crores, he did not waive his right over the remaining 800. He simply said, Manish Furnitures, you can't give me entire 1000 crores, doesn't matter. How much can you give me? You can give me 200, give me 200, use my 800 crores. So tell me, till yesterday, how much money did this organization owe Mr. Manish? It owed Mr. Manish 400 crores. Today, how much money does this organization owe Mr. Manish? It continues to owe him 400, and now it owes him another 800, and therefore, the profit that an organization makes and does not distribute among shareholders also appears on the liability side under a description called reserves. Am I making sense? A lot of people, again, non-finance people, get a little confused. Why do profits appear on the liability side? Answer is, profits are shown on the liability side because the profit belongs to the owner. And if you do not give it to the owner, then you owe it to the owner, right? Now this 4 plus 800 together, 1200 crores also has been given a name. This now will be called Manish's or the shareholders' net worth. Imagine this is a public limited company. Imagine this company raised 400 crores by way of a public issue of shares. So how did they raise 400 crores? They probably issued 40 crore shares, each carrying a face value of 10. Now, out of every year's profit thereafter, a certain amount of profit they used to distribute amongst the shareholders, a certain amount of profit they used to retain within the business. After a few years, the amount of retained profit has mounted to 800 crores. So today, the net worth of the shareholders of this company has become 1200 crores. Tell me, 1200 crores is the net worth of how many shares? It is of 40 shares. So what is the value of one share? 1200 divided by 40. That's 30 rupees. What is 30 rupees called? 30 is now called the book value per share. So here is a company having shares carrying a face value of 10, the price printed on the face of the share certificate. A 10 rupee share is now enjoying a book value of 30 rupees. Now you go to the stock market and find out how much is the share trading for over there. That could be anything. That's outsiders' perception about the company. On an off chance, it could be trading at lower than maybe even 30, which probably could be happening in today's scenario where stock market has got wonderful valuations. But it could also be trading at 300 or maybe even 3000 or even higher. But that is external. These two numbers are internal, face value and book value. Market value is external. Are you all with me so far? I hope I'm not too fast, but if I am fast, the reason is only I want to make sure by the time this session finishes, I have taken you to the logical end. I don't want to leave you hanging. So folks, in the beginning, if you notice, I said balance sheet liabilities represent sources. How many sources are there in an organization? Is the first item a source? Of course. Who gave this money to the organization? The owner. Is the second item reserves a source? Answer is yes. Who gave it to you? Again, the owner. What's the difference between the owner's first contribution and the second contribution? In the first case, the owner physically invested the money. In the second case, the owner may not have invested the money in cash, but they left behind what they could have legitimately taken home. So item number 1 is the owner's direct contribution. Item number 2 is the owner's indirect contribution. Item number 3, is that a source of money? Loan? Of course. Who gave it to you? Some outsider. But folks, businesses not only take money in cash, but they also go to vendors and suppliers and say, can you give me goods and services and I'll pay you later, a month, 2 months, 3 months later? Those items appear as creditors. Tell me, is that a source of money? Answer is yes. What's the difference between the third item and the fourth item? In the case of third item, bank loan, a banker gave you a loan in cash. In the fourth item, instead of giving you loan in cash, it is a loan in kind, but it's a loan nevertheless. Do you now recognize the left side of the balance sheet as being merely a collection of sources. How many sources are there in any organization? Two. Owners contribute, outsiders contribute. Both contribute in two ways: direct, indirect. Owner contributes directly when he puts in the money. Owner contributes indirectly when he leaves behind profit. Outsiders contribute directly when they give you loans in cash, and they contribute indirectly when they give you loans in kind. But folks, the most important question to be answered: why is this organization going around borrowing money from everybody? It is borrowing money from the owners, it is borrowing money from outsiders, it is borrowing directly, it is borrowing indirectly. Do you think this is an arbitrary collection of money, or must it be as per a plan? Do you think this can be an arbitrary collection of money, or must it be as per a design? It better be as per a design. But it's not funny how often it is not. And therefore, in my opinion, many businesses sow the seeds of sickness even before the business has started. Why? Because if this money has come without a definite plan in mind, then you will find you would have either raised less money than you need, or you would have raised more money than you need. Which is a happier state of affairs? Should an organization have less money than it needs, or should it have more money than it needs? Folks, if they have less money than they need, how will they function? They will not be able to buy the assets that they need for their smooth functioning. So if you have less money, you will get into trouble. And if you have more money than you need, I think you will get into bigger trouble. So the mantra that I put a few days back in a post is that please remember, less is bad, more is worse. Now, how less is bad can be readily appreciated. How more is worse, unfortunately, today's time won't permit me to explain that to you. Some other day I will explain. But remember this rule: less is bad, more is worse. And therefore the name of the game is optimization. So how do you know how much money to raise? That answer will be given to you by the right side of your balance sheet. So let's now visualize the right side of this balance sheet. What will Mr. Manish do with this money? Where will he invest this money? A sizable proportion of this money Manish will use to acquire land and building and machinery, infrastructure. These items appear under a heading called fixed assets on the asset side. Let Mr. Manish invest a sizable proportion of money on the acquisition of infrastructure, but Mr. Manish better make sure that he does not exhaust his resources in the process of creating infrastructure alone. Manish has to make sure once he has created infrastructure, there is money left behind. Why? Because he will now require a continuous supply of something known as working capital. Now help me visualize components of working capital. Why does he need working capital? Imagine Manish wanted to start the finest furniture manufacturing company in the country. He wanted to be the best. Because he wanted to be the best, he also wanted the best quality of infrastructure. So when he went to buy the infrastructure, he got a little carried away and he landed up spending more money on infrastructure in his desire to be the best than he should have. What is the result? Result is today Manish has the finest infrastructure in the country to make furniture, but no money left for working capital. And let's say I can see Aditya Mishra. Let's say next day Aditya Mishra lands up over there and he says, Manish, I am starting a new IT services company, and in my company I need 100 crores worth of tables and chairs alone. And looking at your infrastructure, I think you are the best person in the country to supply it to me. I'm very happy to give you an order of 100 crores. Will Manish be able to execute the order? Answer is no. Why not? Doesn't have working capital. So can you help me visualize components of working capital? Why does he need working capital? Folks, Manish is a very lucky person. He started the factory yesterday and today Aditya Mishra lands up with an order. But Manish will have to be far luckier than that for Aditya to say, Manish, I have not only brought you an order of 100 crores, but my order of 100 crores comes along with a check of 100 crores. That's not going to happen. Manish will be lucky enough to get the order. And now he has to understand, in this 100 crore order of Aditya's, 60 crores is the wood component alone. Unless Manish possesses the financial capability, not merely to buy land, building, plant, machinery, but also to invest 60 crore in wood, can he run his business? And as a prudent business person, Manish is not going to buy the wood after the customer has walked in. He will probably buy and maintain an inventory of wood in anticipation of orders, so that the day the customer walks in, production can commence forthwith. So folks, first component of working capital is to possess the financial capability. First to buy infrastructure, and then to be able to invest money and in holding and buying and holding inventory. Second component of working capital is, now Aditya's order of 100 crores is a reasonably large order. Manish needs at least 3 months to execute this order. But folks, next week is the first of the month, and his employees are waiting for salary, his landlord is waiting for rent, overheads have to be paid. Manish can't tell his employees, gentlemen, can you just wait for 3 months? The moment Aditya pays me, I'll pay you your salary. Folks, expenses are continuous, incomes are sporadic. And therefore, prudence demands that you always hold on to sufficient amounts of cash in hand, so that your day-to-day expenses can continue to be met without dependence on inflow from operations. So second component of working capital, to be able to hold on to sufficient amount of cash. And the third component of working capital is, after 3 months of hard work, Manish goes to Aditya, your order is ready, your consignment is ready, would you like to come, inspect, give me the go-ahead? Aditya comes there, says, great job done Manish, now send the goods to me. And Manish says, okay Aditya, what about my check? Aditya says, no problem, come 60 days later and collect your check. Not only Manish did not get advance, even on delivery he may not get paid. And now he needs further financial muscle power to be able to last another 60 days. In the meantime, business has to continue. For third component of working capital is debtors. Who are debtors? Debtors are the people who owe you money. But folks, they will pay you in the future. You are spending now. At great cost, Manish manufactured this product, and he has to tell Aditya, here is your product, take it. No hurry, pay me 60 days later. You need the financial ability to do that. Tell me folks, is the structure of balance sheet okay to all of you? What does a balance sheet indicate? What does the left hand side indicate? Left hand side in India, folks. In US, the liabilities appear on the right and assets appear on the left. So let's not worry about which side it is. And this format is also slightly different. Nowadays, nomenclature here and there has changed. I'll try and bring you up to date on that also. But one side of the balance sheet tells you where the money has come from. The other side tells you what you did with the money. Where does money come from in any organization? How many sources are there? There are 2 sources. Owners and outsiders. Both contribute in 2 ways. Direct and indirect. Where does money go in any organization? Into how many avenues? 2. It goes toward the creation of infrastructure represented by fixed assets, and it goes towards supply of working capital, which is represented by something called current assets. And the components of working capital are maximum 3. You need working capital to be able to buy and maintain inventory. You need working capital to be held in the form of liquid cash. And you need working capital so you can afford to go on spending, making products, delivering it to a customer, and not being paid upfront. Folks, so far, if we are on the same page, I think we are now ready to read balance sheets. You know, if you pick up a real life balance sheet, and I will urge you to do it tonight. If you're running your own business, pick up your own balance sheet. If not, you can go on the internet and download as many balance sheets as you want. Every listed company's balance sheet is available on the internet. I suggest download as many balance sheets as you can. Now, if you pick up a real life balance sheet, what have I been showing you balance sheet looking like? I've been showing you balance sheet looking like, okay, before that, I'm going to check how many of you already know how to read balance sheets. And then I'll come back to this, what I said just now. If you know how to read balance sheets, it will come to your aid on numerous occasions. For example, in your business life, you bump into a potential customer. And the customer says, I can give you a very, very large order. But your normal policy is to give 30 days credit. I want 300 days credit. Should you say yes or no? Should you say no only because 300 days sounds unreasonably long, inordinately long, and in the process lose a very big order? But on the other hand, if you say yes to the wrong kind of a company, you'll never recover your money. If you knew how to read a balance sheet, you would take a more sensible decision, a wiser decision. In your personal life, somebody comes to you, says, give me your life savings, and I'll give you some ridiculous 80, 90% interest per annum. Should you say no only because the interest sounds too good to be true, and in the process lose a once-in-a-lifetime offer? But on the other hand, if you say yes to the wrong kind of a person, you never see your money again. Read the balance sheet. Who's making the offer? How many people used to come selling to us at one time? Timeshares. And so many people lost money. And along the way came Mahindra Holidays, the whole scenario changed. Read the balance sheet. Who's asking for it? You go to a bank to ask for a loan, the banker says, bring your balance sheet. So if you know how to read balance sheets, you will take many decisions which you take, though they will be more sensible. And I want to see how many of you already know how to read balance sheet, because my conviction is almost all of you already know how to read a balance sheet. Perhaps some of you don't know that you know it. So to do that, I want you to imagine you are bankers. Two companies come to you, A comes to you and B comes to you, and both of them say, we want a loan. And you tell them, bring your balance sheets. And they bring their balance sheets, and A's balance sheet looks like this, B's balance sheet looks like this. I want you guys to read these two balance sheets and tell me, if you happen to be the bankers, who will you be willing to give a loan to and who will you be reluctant to lend to? Now again, I have not explained so many things to you, so it's not fair of me to ask you to read these things. But so I'm going to, anyhow, to save time, proceed further. You see, A has got, the right side of both the balance sheets is the same. That means, assumably, they're in the same line, they've invested the same amount of money in infrastructure, working capital is same and so on. Difference lies on the left-hand side. In case of A, how much money has the owner put in? Owner's capital is 450, reserves are 300, 750 out of 1000 has come from the owners, loans are just about 200, and current liabilities are 50. In the case of B, first and second item, 250 has been invested by the owners, loans are 700 and current liabilities are 50. Now very often some people will say we will lend to A. Why? Owner's contribution is higher. A concept that I haven't explained to you is, folks, the most expensive money in an organization is the owner's money. Very often people wrongly think owner's money is free, including some owners themselves. Whereas owner's money is not free, it is the most expensive source of money available. So in the second case, owner's contribution is less. That means the money that costs less is a higher percentage, and the money that is expensive is a lower percentage. So the average cost of capital of B is less. So when I ask who will you give a loan to, some people say A because owner's contribution is higher, reserves are higher. I don't know why that makes you happy. Reserves means you've not distributed enough to the shareholders. And reserve doesn't mean money, just as profit doesn't mean money, reserve doesn't mean money. Any case. So one segment will say we'll give to A because owner's contribution is more, loans are less. Other segment can wear the devil's hat and say A's loans are less because no banker wanted to lend to him. B has a higher loan because he is the favorite of the bankers. And besides, the cost of capital of B is lower. You see, the right side is same, so assumably earning capability is same. If the earning capability is same, and if B's cost of capital is lower, then other things being equal, take home profit will be higher. So there are some people who will say we will lend to B, there are others who will say we will lend to A, and both have given logical explanations for their choice. I completely agree that the cost of capital of B is less, and other things being equal, take home profit will be more. But the question is, how impressed does a banker get when a borrower earns more? Let's say A comes to you to borrow, B comes to you to borrow. They say, Mr. Banker, if you give us a loan, our interest obligation to you is going to be 100 crores each. A says, Mr. Banker, my projections show next year I can earn 1,000 crores. And B says, my projections reveal I can earn 5,000 crores. How much do they owe you as a banker? 100 crores each. How much can A earn? 1,000. How much can B earn? 5,000. If you happen to be the banker, will you be more impressed by B or no? Folks, if you said yes, my next question would be, why would you be impressed? How does it matter to you how much he earns? Is A capable of paying you 100? Yes, he's earning 1,000. Is B capable of paying you 100? Of course. Then how does it matter to you how much B earns? So long as, why would you be more impressed by B as compared to A? Even A, ultimately you are going to get just about 100. Had I said A's earnings are, let's say, 125 and B's earnings are 200, I understand if you choose B, because if A's projection goes slightly haywire, he won't even be able to afford to pay you interest. But in case of A, he earns 10 times more. Even if his projections are off by maybe 80%, he will still be able to pay you interest. Point I'm trying to make is, when it comes to choosing between profitability and stability, bankers go for stability. Folks, tell me, what is the difference between owner as an investor and somebody like a banker as an investor? The difference is, bankers and outsiders are passive investors. Owners are active investors. Bankers merely lend you money. Owners not only lend you money, but having invested money, they also get involved in the day-to-day running of the business also. And how safe a business is going to be to a large extent will depend upon the level of involvement of the owner. If the owner is completely involved, owner nurtures the business, owner takes care of the business, chances are the business will do well and the banker will be safe. If the owner was to neglect the business and therefore the business gets into trouble, owner will of course lose his money, but along with his, he will also lose the banker's money. So the first concern of the banker is, where is it likely that this owner will give a lot of time and attention, and where is it likely he might neglect the business? And the straightforward answer is, how much does the owner stand to suffer if the business goes under? Tell me, if B shuts down because of owner's neglect, how much will the owners lose and how much will the outsiders lose? Owners will lose 250. Bulk of the money will be the outsiders. If A closes down because of owner's neglect, how much will the owners lose? How much will the bankers lose? Owners stand to lose much more. So chances are, in the case of A, to protect their own investment, the owners will give a lot of time and attention, and in the process, the banker will also be safe. So in banking parlance, we say, bankers love it if the owners have more skin in the game. Where do owners have more skin in the game? In the case of A. Your answer would have been different had I asked you, whose shares would you like to buy? Folks, how do you read a balance sheet will depend upon what hat are you wearing. Right now, you were asked to wear the hat of a banker. Had it been whose shares would you buy, I would probably go for B. Why? Because the more that you earn, the greater the return that you will get. Bankers' returns are frozen. Because bankers' returns are frozen, they're going to earn the same from A and they're going to earn the same from B. Then why would they want to risk it? Second way of looking at it is, you must always take the worst case view before you deal with anybody. What is the worst that can happen once you give money to this company? The worst that can happen is this company will shut down. If the company shuts down, how will you as a banker recover the money? Let's look at B again. How much money, what are the total assets available with B? 1,000. But folks, out of 1,000, 250 happen to be current assets. whose realization becomes a bit of a question mark if a business shuts down. And the remaining fixed assets are also shown on a balance sheet at what is known as book value. If a distressed kind of sale is going on, the assets may not even fetch equal to the book value. So chances are, if B shuts down, its assets of 1,000 can probably be sold for 600, 500, 400. But folks, the liability towards outsiders is 750. Every lender will not get the money back. You give a loan to A, and let's say the worst thing happens, this company closes down, liability towards outsiders is 250, but the value of assets is 1,000. If the 1,000 worth of assets can be sold for 600, 500, even for 300, every lender gets the money back. Therefore, the comfort that a banker derives will be substantially greater from A as compared to B. Not important, folks. I was saying, even before I tell you how to read a balance sheet, to a certain extent you probably already know how to read balance sheets. Let me now refine this ability further. I was saying, if you wish to read a balance sheet, pick up a real life balance sheet. As I started saying before that, go on the internet, download as many balance sheets as you can. Now, I have been showing you balance sheet looking like this. How many items on the left hand side? 4. How many on the right hand side? 2. Now, if you pick up a real life balance sheet, you just might, I keep saying left and right, folks, but very often nowadays balance sheets are presented in a vertical fashion. So what is being shown on left and right in a real life will be on top and bottom. On the top there could be liabilities, bottom there could be assets, or on the top there could be assets and bottom there could be liabilities. Don't let that confuse you, right? This format can keep changing, left, right, top, bottom. Sometimes assets go up, sometimes liabilities go up. Similarly, while I'm at it, let me also clarify, I've been writing long-term loans and current liabilities. On the right-hand side, I've written fixed assets and current assets. Today, the terminology has changed to current liabilities are still called current liabilities, but long-term loans are called non-current liabilities. Similarly, current assets are still called current assets, but fixed assets are called non-current assets. So when you pick up a real life, these are the terms that you'll come across. So I said you pick up a real life balance sheet. I've been showing you 4 items on the sources side, 2 items on the user side. But in a real life balance sheet, you just might find it actually has 4 and 2. Or you might find your balance sheet has numerous items on each side. 15, 20, 30 items on each side. Tell me, if the balance sheet that you're trying to read has got numerous items on each side, how is that balance sheet different from what I have been showing you? Answer is, if your balance sheet has many items on each side, it will mean you are holding in your hands a raw balance sheet, where somebody hasn't bothered to apply his mind and club similar figures together. Or I'm trying to tell you, every balance sheet can be made to look like this. Step number 1, if you wish to read a balance sheet, for heaven's sake, make sure the balance sheet looks like this. If it doesn't look like this, I suggest you make it look like this. Do you think you can do it on your own? It's very important, folks. Whatever I'm telling you, you're able to do on your own. If you still need to consult somebody, we're wasting time. What I'm trying to tell you is, doesn't matter how many shapes and forms in which the owner has contributed, club it into one figure called capital. Balance sheet will give you classification between equity and preference. I don't want the details, folks. Give me one figure of owner's contribution. Next item is reserves. Now, reserves is not one. A company, when it makes a profit, retains profit for many purposes. So reserves sometimes go into specific reserves, sometimes they're shown as general reserves. So reserves in a balance sheet could be 15, 20, 30 different kind of reserves. You can find asset replenishment reserve, dividend equalization reserve, debenture redemption reserve, or a sinking fund, or just as profit loss account itself. Folks, it will not help your understanding at all. I don't want to know why this company did not distribute profit. I want to know how much profit it did not distribute. So if you find many items of reserves, club them together. This company could have taken loans from numerous entities. How will it add to your understanding? The accountant should know those details, who has to issue checks of installment. As a reader of balance sheet, I want one figure of long-term loans. Don't give me the names of banks who gave you the loans. When is a loan called long term? Any loan not to be repaid within a year is long term. If the liability will mature within a year, it becomes a current liability. So all sources can be broken up into four: owner's contribution direct, owner's contribution indirect, reserves, long-term loans taken from doesn't matter how many entities, and those liabilities which have to be paid back within a year, 365 days from the date of the balance sheet. Right hand side is even easier. Land, building, plant, machinery, furniture, fixtures, tools, software, hardware, vehicles, all these will be shown as fixed assets, and current assets, you know the three items: inventory, cash, and debtors. Folks, step number one: you want to read a balance sheet, make sure the balance sheet you're trying to read looks like this. If it doesn't look like this, make it look like this. I'm going to give you a few steps how to read a balance sheet. Step number two: I think even this is not fair. What's not fair? How many items are there on the user side, on the right hand side? 2. Then why should the left hand side have 4? I think let's make it a truly balanced balance sheet. Can you now help me shrink the sources side to 2? Again, I don't have time for interactivity, or I would have loved to ask you your answers and so on. Your immediate impulse in many cases would be, let's club the first 2 and the last 2. Why should we club the first 2? Because those represent owner's money and the last 2 represent outsider's money. That's a good answer, but it's not going to help me read balance sheets better. A better answer would be, club the first and the second and the third. What is common in the first 3? All those 3 are long-term sources of money. Do you agree? Share capital, lifelong. Reserves, almost as long. Long-term loans, name says long-term. So the first 3 items represent long-term sources of money, and current liabilities represent short-term sources of money. An item is classified as current liability only if it has to be paid back within a year. On the right-hand side, folks, can I say fixed assets represent long-term uses of money? How is it a long-term use? Fixed assets are bought for use, not for trading purposes. And very often, once you set up factories for years together, you'll be there. We have in Pune, where I live, Tata Motors in Pimpri. Maybe they bought the land in early 60s. It's been 60 years and they still haven't sold. It's still there. If you go to Bombay, to Powai, half of Powai is owned by L&T. Again, it was bought in early 60s. So once you buy fixed assets, you sit on it for years together. Can I say current assets are short-term uses of money? How are current assets short-term uses? Folks, if you remember, current assets, I've called it as working capital. And working capital can actually be depicted like a cycle. It is either called the working capital cycle, or it is called the cash to cash cycle. Let me show you a working capital cycle of a manufacturing company. In a manufacturing company, let's say the cycle begins where? It starts with cash. Then what do? You spend the cash, you buy raw materials, it becomes inventory. Then inventory goes into production process, it becomes finished goods. Finished goods, you find a customer, it becomes debtors. When you collect money from your debtors, it comes back in the form of cash. This cycle is called either the working capital cycle or the cash to cash cycle. And one of the tricks of good finance management is your ability to shorten this cycle. Let's take 2 examples. Let's say there's this company which goes to a bank, I want 100 crore working capital loan. Banker asks the person, why do you want 100 crore working capital loan? He says, I want to maintain inventory. And banker says, what kind of inventory would you like to maintain? He says, see, it should never happen that there are orders on the shop floor and no raw material. On the safe side, I would like to maintain 3 months of inventory. His product goes into production cycle. He says, I am an international player. My product has to be of global standards. So to make sure that I don't compromise on quality, I must take at least a month to convert raw material to finished products. Then when the product is ready, he says, those days are gone where a customer used to come and I could afford to tell the customer, you want to buy from me? Okay, do one thing. Give me an order, give me an advance, and collect your material after 3-4 months. Again, in Pune where I live, there's a company called Bajaj Auto. It used to say, give me an advance, give me an order, and collect your scooter 5, 7, 10 years later. That kind of waiting list it used to have because it was an extremely popular product. Today's customer expects finished goods displayed on a shelf. So this person says, I have to maintain a finished goods inventory also 1 month so that the day the customer walks in, I can tell him, take your product right away. And he says, I'll be a fool if I think I can tell my customer who comes to me, you want to buy from me, give me cash, otherwise go away. Chances are the customer will go away. He goes to your neighbor. Neighbor says, take it, pay me after 2 months. Now the neighbor is going to say, pay me after 2 months. When will this customer come to me? Only if I tell him, pay me after 3 months. Tell me, how long will this one working capital cycle take? It will take 8 months. How many cycles will he achieve in a year? 1.5. 100 crore invested will probably generate a turnover of 150 crores. Now this guy's got a neighbor. The neighbor also goes to a bank, I want a 100 crore working capital loan. And the banker says, why? He says, I want to maintain inventory. Banker says, how much inventory? Now this fellow not only understands I need inventory, but he also understands that mantra that I gave you in the beginning. What was the mantra? Less is bad, more is worse. He says, of course I need inventory. But why 3 months? How much inventory to maintain should not be a figure that comes out of my hat. He says, to understand the need for inventory, what I'm going to do, I will first do a sales forecast. Based on that, I will do a production forecast. Based on that, I will do an inventory need analysis. Then I'll have meeting with suppliers to see that I can reduce the lead time between placement of order and receipt of material. Ultimate intention is I have to head towards what is known as just-in-time inventory. But he says, in the meantime, I can manage with 1 month. His product goes into production cycle. He says, I am also an international player. I understand the importance of quality, but I don't agree that the longer the time taken to produce, the better the quality. I can probably cut down my production time from 30 days to 15 days and still make sure that I don't compromise on quality. And he says, finished goods inventory also 15 days enough. And when customers come to buy, he says, I don't agree that the single yardstick used by customers to buy or not to buy is the period of credit. They look at so many more things. They look at my product quality. In certain cases, they see my packaging quality. They see my pre-sale service. They look at my after-sale service. If need be, I will offer them a slight discount, but I will convince my customers to pay me within a month. How long will his cycle take? 3 months. How many cycles will he achieve in a year? 4. 2 identical businesses doing the same thing, borrowing the same. One fellow borrows 100 crore, generates a turnover of 150 crores. Second fellow borrows 100 crore, generates a turnover of 400 crore. The neighbor doesn't understand how are we different. We are doing exactly the same thing. Why is this person so much more prosperous than I am? Answer is, this man's working capital management is more efficient. This man's finance management is more efficient. Do you agree this falls into the category of good finance management? Now tell me, who's involved in this practice of good finance management? From the first stage, who's involved? The purchase department. Second step, who's involved? The production department. Third step, who's involved? The sales guys. Have you noticed not a single so-called accounts and finance person is over here? Which is why I keep saying more finance management happens outside the finance department than inside the finance department. And funnily, these people call themselves non-finance people. Do you see the paradox? But today is not the time to discuss that. Right now, for my discussion, it doesn't matter. Whether it takes 3 months or it takes 8 months, whether you are efficient or you are inefficient, if money can come back within 1 year, we call it short term. So do you agree the efficient fellow's working capital is also short term and inefficient fellow's working capital is also short term? Folks, it looks like I'm going to exceed the time. With your permission, can I extend the session a little bit? I said 5 to 6. If some of you have come exactly with 1 hour to spare, my apologies to you. I don't think I'll finish. I mean, maybe another 10-15 minutes. But the good news would be, hopefully, this recorded version will also be available. So in case some of you have given commitments post 6 and you need to go, I understand. You could look back at the recorded version. Rest of you, do I have your permission? I can, if some of you answer. I hear a few yeses, so thank you so much. I'm going to continue. Are you all okay so far? I was telling you, if you wish to read a balance sheet, pick up a real life balance sheet. Step number 1, I said real life balance sheets have how many items on the left? 4 on the left, 2 on the right. If they don't have 4 and 2, You bring them down to 4 and 2. And then I said bring them down to 2 and 2. How will you do that? Club the first 3 items on the sources side and call them long-term sources. Current liabilities are short-term sources. Fixed assets, we will call them long-term users. Current assets, we will call them short-term users. If you guys are okay so far, I think you are now ready to read balance sheets. I was telling you earlier, I'll say so again, tonight itself go on the internet and download as many balance sheets as you can. Even if you download 100 balance sheets and do this, you are going to discover in this world, how many types of balance sheets are there? Even if you do this to 100 balance sheets, you will discover actually in this world there are only 3 types of balance sheets. Every balance sheet that you're holding in your hands, you will be able to recognize that this is a type A balance sheet or a type B balance sheet or a type C balance sheet. There are only 3 types of balance sheets in this world. And what do these 3 types of balance sheets look like? Here is what they look like. Type A balance sheet looks like this. Type B looks like this. And type C looks like this. Now watch these 3 carefully and tell me, what do I mean every balance sheet has to look like this? You might be thinking, if you're familiar with your own balance sheet, you might be thinking mine looks very different. So what do you mean every balance sheet has to be type A, type B, type C? When will we call a balance sheet type A? When will we call it type B? When will we call it type C? What is the characteristic of each of these 3 types of balance sheets? How are you reading these balance sheets, folks? Are you reading them vertically or are you reading them horizontally? If you're reading them vertically, don't. Look at them horizontally. And then you realize that 80-20 in balance sheet A has no relevance. 80-80 has relevance. It doesn't matter if it is 80 and 20 or if it was 20 and 80. So long as if the long-term sources were 20 and long-term users were 20 and short-term sources were 80 and short-term users were 80, we will call it type A. Where the long-term sources are lesser than long-term users and short-term sources are greater than short-term users, we will call it B. And when long-term sources are more and short-term sources, other way around. My problem is right now all your comments are coming on the balance sheet. So far as I am concerned, I missed it. I repeat, where long-term sources and long-term sources and long-term users are the same, short-term sources and short-term users are same, type A. Long-term sources are greater than long-term users and short-term are lesser, type B. When long-term are lesser and short-term are greater, we will call it C. Do you agree? There cannot be a 4th type of balance sheet. I have, as usual, shown you 2-digit numbers. I've frozen the right hand side. It's easy to recognize. Real life will have more complicated numbers. So I'm going to show you 3 more and ask you to tell me which is which. Real life will look like this. And imagine there are many zeros after each number. Real life balance sheet will look like this. Can you tell me which is A, which is B, which is C? First one seems to be, see, long-term sources are less than long-term users. Short-term are more. So this is C. Middle one looks like A. And the last one looks like type B. So folks, it doesn't matter whether it's a simplistic looking balance sheet as I showed you first or a complicated looking balance sheet which I showed you now. Putting a label A, B, C is not difficult. Now second time I'm going to ask you, without having told you how to read balance sheets, second time I will expect you to read balance sheets. Watch these 3 and tell me which one is the healthiest of the 3. I'm seeing answers coming in. Wonderful, guys. I'm sorry, due to the time constraint, I'm not responding to you individually, but off and on I can see your comments coming in. Very good answers. Ranveer Singh Rathore, you're absolutely right. Oh, but which one is A, C, B? No, it is C, A, B, right? Okay. Folks, tell me which is the healthiest of the 3. Okay, since I can't make it interactive, I'm going to continue. Let me first describe the 3 to you. I suggest to make it more interesting, for your own sake, choose which you think is the healthiest and then compare it when I give you the answers. Right? I'm getting some answers. Kishore and Yatin say A is best. Arja says B is better. Mihir also thinks B is better. Rinku says C is better, and so on. Continue giving the answers, folks. I'm going to give you some more input first. How do we describe company A? How much long-term money do they have? 80. How much is the long-term use? 80. Short-term money 20. Short-term use 20. It looks like in the case of A, they use the long-term money to buy long-term assets and short-term money to buy short-term assets. A can be described as a company which has used the long-term funds for long-term purposes and the short-term funds for short-term purposes. How do you describe B? How much is the long-term sources? 90. How much is the long-term uses? 80. It appears that all long-term uses must have been funded from long-term sources and they have a surplus of 10. So far as short-term is concerned, the money available is 10, the utilization is 20, they're running short of 10. So how did they bridge the gap? They apparently have used that extra long-term to buy the short-term assets. So B can be described as a company that has used a portion of long-term funds for short-term purposes. C has 70 long-term sources and 80 long-term uses. That means even if all the long-term money went to buy the long-term assets, they are still running short of 10. But so far as short-term is concerned, they have got an extra 10. So it looks like that extra must have been diverted for long-term purposes. C can be described as a company that has used a part of short-term funds for long-term purposes. This is a factual description of the three. Question is, who is following sound finance management policies? Now, folks, give me the answers. Think about it and let me know. Do you think A is the best, or B is the best, or C is the best? Wonderful. Sarvanan says B, A, C. So best is B, next is A, next is C. Deepak Grover says C is better. Satyanarayan, you haven't given the answer. Kisan thinks B is the best company. Krishna Kumar, C. Wonderful. Carry on, guys. Now let us find out who of you is right. Let's begin with C. Folks, in a business, you got to remember, liabilities represent sources. But what did I tell you? These sources are in the nature of borrowings. They're not gifts. That means anyone who gives you the money today will be standing outside your door sometime or the other saying, I want my money back. But what have you done? You've taken this money and deployed it for buying assets. But these sources are going to expect it back. So how will you give it back? And therefore the rule is, invest your money in such a way that the assets will bring it back before the liabilities ask for it back. Remember this rule. Very, very important. Most businesses that shut down, you'll be able to trace them to this violation of what I'm telling you just now. I repeat, sources are not gifts, they are liabilities. You use these sources to acquire assets. So your money gets deployed, money gets blocked. But these sources will expect it back. And therefore, when you invest the money, you must invest in such a way that the assets can bring the money back before the liabilities ask for it back. So the rule says liabilities have to be paid back. But folks, you appreciate some liabilities have to be paid back faster than others? And which liability has to be paid back fastest? The short term? Which is why I asked you to represent the sources side as isolate the short term, club the long term. That is the reason I did that. Now let's start with C. In the case of C, who is going to come knocking on the doors of this company in the very near future? Can I have my money back? How much will they be expected to pay back? They'll be expected to pay back 30. Let's say 30 crores. And the rule that I just gave you said, when people come knocking on your doors, can I have my money back? At that point of time, for heaven's sake, make sure on the right hand side there are doors available to you where you can go knocking, can I have my money back so I can pay my short term liabilities? And on the right hand side, which asset will bring the money back in the short period, long term or short term? Folks, you appreciate long term assets won't bring the money back. When did Tata Motors buy the Pimpri land in Pune? 1960s. When did L&T purchase Powai land? Again in the 60s. Till date the money hasn't come back, and God knows how many more years it won't come back, because they did not buy it to sell, they bought it for use. And the only asset that will bring money back in the short period is the short term. And how will the short term asset bring the money back? Because via the movement of the working capital cycle, every now and then this cash is going to come back in the form of cash. How much cash can C generate in the short period? 20. How much cash will C be expected to pay in the short period? 30. How will they pay? Folks, when the short term assets are insufficient to meet the short term liabilities, then organizations are forced to sell the long term assets to pay the short term liabilities. And when an organization has to sell its land, its buildings, its equipment and machinery to pay who? A short term liability? To me, that looks like the beginning of the end of that organization. C is in serious trouble. C is on the verge of insolvency. And why is C in serious trouble? Because C is guilty of having used short-term funds to acquire long-term assets. Don't ever do that. To the entrepreneurs watching this right now, my appeal to you is right now go buy a slab of stone, engrave this on that right now, that I will never ever use. Doesn't matter the temptation, I will never use short-term money to acquire long-term assets, and put this slab of stone somewhere in your office where you can read it every day. I was writing a LinkedIn post sometime back that if there was a graveyard of failed companies, the tombstone in front of many would have read, "Here lies a company that used short-term money to acquire long-term assets." Today is not the time to give you case studies, but I can give you tons of cases where fantastic companies a few years back don't exist anymore because they did precisely that. Every person from the real estate watching this, all your friends who are in trouble right now are the ones who used short-term money to acquire the land bank and so on. Those who didn't violate this rule are still surviving. So folks, C is out. What does that leave you with? That leaves you with A and B. Now let us find out which is better between A and B. I'll give you the rule for a healthy company now. The rule for a healthy company is healthy organizations will make sure that they use long-term funds to acquire long-term assets, short-term funds to acquire short-term assets. Who has followed the rule to the T? A. Which is the best company? Folks, A has followed the rule. A is no doubt better than C. But B is even better than A. Why am I contradicting myself? I told you healthy companies use long-term money to buy long-term assets, short-term money to buy short-term assets. A has done exactly that. I've also given you the mantra, less is bad, more is worse. A neither seems to have less nor more. Then why am I violating my own rule and saying A is better than C, but B is better than A? The reason is something else. Tell me who's going to come knocking on the doors of A in the very, very near future saying, can I have my money back? How much will they be expected to pay? 20 crores. How much do they have in the form of short-term assets? 20 crores. Let us remove the long-term. How much do they have to pay? 20. How much do they have? 20. Height of efficiency. Epitome of efficiency. But do you remember the breakup of the 20 on the right-hand side? Remember those three items? Who's that person on the left? Let's say our entrepreneur Manish went to a vendor, said, give me wood, I'll pay you next month. Next month that vendor came knocking on the doors, Manish, can I have my money back? Folks, when this vendor comes knocking on the doors, can Manish use cash to pay him? Of course, cash is ready. Can he use debtors to pay him? Let's give them a level playing field right now. Right hand side we have debtors, left hand side we have creditors. You are supposed to collect from debtors and you can use that money to pay creditors, right? Manish can use cash to pay creditors. Manish can use debtors to pay creditors. Can Manish use inventory to pay creditors? No. Why not? What business is Manish in? Furniture. So what must be that inventory? It must be wood. And who's that creditor on the left hand side? He's the fellow who gave you the wood. So when I say use inventory to pay him, what I'm telling you is, he went to the vendor the other day, give me wood, I'll pay you next month. When the vendor came asking for money, he said, take your wood back. We're not here to play games. And therefore, if inventory is not available to be paid back, then money still doesn't have money to pay the vendor. And that, folks, brings me to a key accounting ratio. Those items on the right hand side, short-term uses, are called current assets. Those short-term sources on the left-hand side are called current liabilities. And the ratio between current assets and current liabilities is called the current ratio. And the norm is healthy organizations will try and maintain a current ratio of about 2:1. How much is the current ratio of A? 1:1. How much is the current ratio of B? 2:1. How much is the current ratio of C? 1:1.5. Good thing about knowing norms is, even if you don't know the logic behind it, what do the norms say? Current ratio should be 2:1. Who's got 2:1? B. Which is the best company? B. But can B also get into trouble? Answer is yes. How? How much do they owe people? 10. How much do they have? 20. But the important thing is, what is the breakup of that 20? If inventory is not available to pay, then if you ignore the inventory, the remaining 2 should be minimum 10. Or the inventory of B should be maximum 10. That brings me to the next ratio. The first 2 items of current assets are either called liquid current assets or they are called quick assets. And inventory is non-liquid. And healthy organizations within a current ratio 2:1 will try and maintain a liquidity ratio, a quick ratio of minimum 1:1. I'm going to stop here. Somewhere I have to stop. These things can go on and on and on. I'm sorry once again for the speed, but the idea was, I still didn't finish within an hour despite the speed. So you can imagine, had I been slower, we would not have reached anywhere. I want to keep 5-7 minutes for question answers. Anything that you didn't understand, anything you want little explanation for. Now I'll read some of your messages also. I'm sorry you've been writing, but I didn't get the chance to look at them. Yeah, I'll pick up 2-3 questions maybe and see. Nani says, I have a doubt, if inventory is 15 crores, how will it be healthier? Where did you get the number of 15 crores from, Nani? Just apply those current ratio, liquid ratio, I think you'll get your answer. Thank you very much, Sudhir Sharma. Yatin, good to see you here. Wonderful. I'm waiting for questions to come in. Some of you are giving some very, very heartwarming comments, and I'm loving them, of course. But if any questions are there, I'd love to answer those. Kishore Keswani, I know you wanted to know why is more worse, but even today I have not answered that. I need another long session for that. Statement I've already made. Explanation will take a long time. Milind Babar, thank you so much. Thanks, Milind. Wonderful to see you here. Yogesh, what is that? Whose current ratio is 1:1.4? Are you talking about your own balance sheet? Then it's little. Find out, go into more details, or send me a separate email, please. Thank you, Akshay. Thank you for your nice comments. Madhur, I agree. More examples would have helped, but we have time constraints. Murli, thank you so much. Yes, we'll try to have these more frequently. So nice. I'm really enjoying reading your comments, folks. But this was such a pleasure. We are going through crazy times. We are all grounded. We are all sitting at home. So let us use such time to do some learning. I am once again obliged for your tremendous response. Thank you. Continue sending your comments. You can post on my page, on my LinkedIn page, on my Facebook, send me emails. Let's keep the dialogue going, and I look forward to having another session with you guys. Thank you very much. Have a good night.